week is coming to an end, and we take a peek at what next week has in store for the markets. On the monetary front, we highlight the release of the Fed's interest rate decision and the release of the BOC's summary of deliberations on Wednesday. Norway's, the BOE's and the CBT's interest rate decisions on Thursday, and the BOJ's interest rate decision on Friday. As for financial releases, we get on Monday from the US the New York Fed manufacturing figure for September and Canada's manufacturing sales rate for July. On Tuesday, we get Germany's ZEW figures for September, Canada's housing starts figure, the US retail sales rate, Canada's CPI rates, and the US industrial production rate, all for the month of August. On Wednesday, we get Japan's machinery orders rate for July and trade balance figure for August, the UK CPI rate and the Eurozone's final HICP rate, both for the month of August. On Thursday, we get New Zealand's GDP rate for Q2, Australia's employment data for August, the US weekly initial jobless claims figure, and the US fully fed business index for September. On Friday, we get Japan's CPI rates for August, the UK's retail sales rate for August, France's business figure for September, Canada's producer prices rate for August, and ending of the week is the Eurozone's preliminary consumer confidence figure for September. We make a start for the US dollar by noting that the US headline CPI rate for August came in as expected, implying easing inflation pressures in the US economy. In turn, this appears to have eased market expectations of an aggressive 50 basis point rate cut by the Fed in their monetary policy meeting next week. In particular, the majority of market participants are anticipating the bank to cut by 25 basis points, with Fed funds futures currently implying an 83% probability for such a scenario to materialize. Continuing on a monetary level, the Office of the Inspector General found that Atlanta Fed President Bostic violated the FOMC's blackout rule, amongst others, and created an, quote, appearance of acting on confidential FOMC information, end quote. Nonetheless, the consequences, or if there will be, are yet to be revealed. On a political level, we note that the first presidential debate between Harris and Trump occurred on Monday, with numerous media outlets claiming that Harris outperformed Trump, which may cast doubt over the outcome of the US presidential election and thus may increase volatility in the greenback. In the coming week, we highlight the release of the US retail sales rate for August, which is expected to showcase a weakening from the consumer side of the US economy and could weigh on the US dollar. On a fundamental level for pound traders, we note that the Office for Budget Responsibility warned that the British public debt is likely to soar to triple its current level over the next 50 years if future governments do not take action. On the monetary front, we note that the market's expectations for the BOE to take a breather in the next meeting, with GBP OIS currently implying a 76.71% probability for such a scenario to materialize. Moreover, the bank is expected to continue cutting rates from November onwards. Such market expectations could provide support for the pound against the dollar, given the market expectations for the Fed to start cutting rates. On a macroeconomic level, we highlight the release of the UK GDP rates for July, which came in lower than expected, implying a slower expansion of the UK economy. Moreover, the industrial output and manufacturing output growth rate, both for July, decelerated, which may intensify the bearish sentiment for the pound. On a fundamental level, we note for JPY traders that according to a report by the Financial Times, the country is facing its biggest rice shortage in 30 years and may be worth monitoring until the issue is resolved. On a monetary level, we would like to note the BOJ's interest rate decision, which is set to occur next week. Currently, the majority of market participants are anticipating the bank to remain on hold at 0.25%, with JPY OIS currently implying a 99.5% probability for such a scenario to materialize. However, despite the current market expectations of the bank remaining on hold in their next meeting, we would not be surprised to see the bank's accompanying statement take a more hawkish tone. In particular, BOJ member Tamura stated, according to Reuters, that it is necessary to push up our short-term policy rate at least to around 1% to sustainably achieve the BOJ's price goal. Hence, should the BOJ's accompanying statement appear predominantly hawkish in nature, it could support the JPY. On a macroeconomic level, the JPY's GDP rate for Q2 came in lower than expected, implying that the Japanese economy grew but at a slower rate, which could be a cause of concern, and should it deteriorate, it may weigh on the JPY. Nonetheless, for next week, we would like to note Japan's CPI rate for August, in which should signs be shown that inflation is nearing the bank's 2% target sustainably, it may provide greater confidence for the bank to continue hiking interest rates. Moving on to the euro, the bank cut both the refinancing and deposit rate as it was widely expected. However, according to ECB President Lagarde, services inflation is still higher than expected, which appears to have caused a slight upwards revision of core inflation expectations for 2024 and 2025, which could imply that the bank may need to withhold from aggressively cutting interest rates in order to combat inflationary pressures in the zone. In turn, this appears to have aided the common currency following its release, as concerns about a persistence of inflationary pressures in the Eurozone appear to be on the mind of ECB policymakers. On a fundamental level, we note that the decision by German authorities to conduct checks at all land frontiers in a bid to stem illegal immigration appears to be causing a rift between Germany and its European allies, with Donald Tusk stating per the FT that the announcement by Germany is unacceptable and that it is a de facto suspension of the Schengen Agreement on a large scale. Overall, should rifts appear within the EU, it could weigh on the common currency. Moving on to Australia. On a macroeconomic level, we know that for Aussie traders, it was a pretty easygoing week in terms of financial releases, as there were none stemming from Australia, and thus attention may turn to next week's employment data. In particular, we place emphasis on the unemployment rate for August, which is set to be released on Thursday. Should the unemployment rate come in higher than the previous rate of 4.2% and thus imply a loosening labour market, it could potentially increase pressure on the RBA to cut interest rates. On another microeconomic level, we would like to note that China's trade data, and in particular their imports rate for August, which came in at lower than expected at 0.5% versus the expected rate of 2%. Hence, the lower than expected imports rate may imply a reduction in demand for raw materials stemming from Australia, given their close economic ties, and thus it could weigh on the Aussie. On a deeper fundamental level, we would also like to note that the recent crackdown by Chinese authorities on investment bankers could reduce foreign investment into the Chinese financial sector. In turn, a reduction of investment in the country could dampen the nation's economic recovery hopes, and thus, given the close economic ties with Australia, it could also slightly weigh on the Australian dollar. For Canada, on a macroeconomic level, Canada's employment data for August, which was released last Friday, showcased a loosening labour market. In particular, the unemployment rate ticked upwards from 6.4% to 6.6%, in addition to the employment change figure coming in lower than expected at 22.1k versus the expected figure of 23.7k. Furthermore, Canada's IBPMI figure came in lower than expected at 48.2 versus 55.3. Overall, last week's financial releases stemming from Canada appear to have indicated negative implications for the Canadian economy, which may have weighed on the CAD. On a monetary policy level, we note that the implications of a struggling Canadian economy may increase pressure on the BOC to cut interest rates more aggressively, which may further weigh on the Canadian dollar. In addition, a greater degree of emphasis may be placed on the release of the BOC's summary of deliberations on Wednesday, where should it be implied that the bank may continue on its rate-cutting cycle, it may weigh on the loonie. However, should it imply some form of hesitation from BOC policymakers, it could have the opposite effect. Lastly, on a fundamental level, we would like to note that oil prices appear to have remained flat since the beginning of this week. Yet, should they continue on their overall downward trajectory, it could weigh on the loonie, given Canada's status as a major oil-producing country. As an epilogue, we expect the US dollar to maintain the initiative over other currencies in the FX market, mainly due to the Fed's interest rate decision. Yet, other currencies, such as the British pound, could come under the spotlight, which in turn may enrich the trading mix. As for US stock markets, we note some relief for US stock markets, with the Dow Jones, S&P 500 and Nasdaq all moving higher since the beginning of this week. We expect that the Fed's interest rate decision could have an effect in the direction of the US stock markets. As for gold's price, we note that the precious metal has formed new all-time highs this week. Also, the clear drop of US yield since the start of the week tends to enhance the positive effect for gold's price. Thank you all for watching from IronFX, and we'll see you all next week.
Okay, I'm gonna go ahead and get started. Okay, so welcome to today's webinar. Um, as per usual, a risk warning and disclaimer before we get started. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to start off by looking at how exactly you can trade a breakout by looking at price action. And then we'll look at some candlestick breakout patterns, followed by pullback, support and resistance for bullish as well as bearish breakouts. And then we'll look at correlation, followed by multi-step stop loss and picking your entry and take profit. Okay, let's go ahead and get started. So here's our price action trading approach. Firstly, let's talk about reversal and then we'll talk about breakout. So why is it not? Okay, so this is basically the reversal. The reversal occurs at the edge of our channel, right? So you can see price bouncing off of that channel. Here, price is moving in an ascending trend channel. So you can see price recently reversed off of that, the top of the channel. And then we see this morning star formation forming here. And if you're not familiar with candlestick patterns, not to worry, I will go through some of the formations, top used formations in the next couple of slides. But here we have a morning star formation giving us a reversal pattern. Okay, and then price then breaks above this what we call an overlap level. Overlap basically means that there are swing highs as well as swing lows that line up in that same area. Okay, so with price lining up, price breaking out of that overlap area, we see that bounce over here and it breaks out of this area here. Okay, so the breakout now happens out of this resistance area. Okay, so as I mentioned earlier, overlap occurs when you have swing highs and swing lows that line up. So we have two swing highs and one swing low here. So we're looking for this resistance area to break out of. And you can see there is this formation here as well. I'll go through this in a bit. And this is called the three white soldiers, and you can see price breaking out of it. So the three white soldiers basically means that prices, it gives us a signal that prices are going to continue in this uptrend. Okay, so it's breaking out of that level and we expect it to continue, which it did here. Okay. Okay, so now let's talk a bit about the anatomy of candlestick, and we'll briefly go through the different breakout strategies for candlesticks in a little bit. So you can see this is the anatomy of a bullish and bearish candle. Starting off with bullish, we have the high price, close price at the upper wick, and the body, followed by the body, and then the open price and the low price. Whereas for a bearish candle would just be the opposite. So starting with high price again, the open price occurs at the start of the top of the body, and close price occurs at the bottom since we are going in a downtrend. So the open price would be here, close price here, and then your low price is just the tail of the candlestick. Okay, so let's start off with our top three candlestick patterns. Okay, Let's firstly look at the hanging man. Excuse me. So with our hanging man, you can see prices are just moving downwards at the start. Um, okay, starting off with hammer, we'll get into hanging man in a bit. Hammer's just, we're just looking at this one candlestick here. So it's a shorter upper wick followed by a small body and then a long bottom wick. The hanging man would just be the opposite of that. So these kind of tell us that we can expect a reversal in price. So here for the hammer, prices are moving in a downtrend. Once we see this hammer, it's a indication that prices are going to reverse and head upwards. Hanging man would just be the opposite of that. Okay, next we're looking at inverted hammer and a shooting star. So again, these two are signals that prices are going to reverse off of whatever these levels are. Normally, prices will reverse off of pullback levels, so your support levels or your overlap levels that we went through earlier. And I'll go through a couple of pullback levels as well in the coming slides. But basically, inverted hammer occurs when prices are moving in a downtrend, and then we see this and we're expecting a reversal to an uptrend. Shooting star occurs in an uptrend. Once we see this, we're expecting prices to go in a downtrend. So pretty straightforward so far. It's more about being able to identify these candlestick shapes. And the last single candlestick pattern that we have are the doji candlestick patterns. Okay. So for our dragonfly doji, it's a sign that prices again are going to reverse. But instead of having our usual body of candlestick, we are greeted by this T kind of shape. Oop. So if we go back, you can see in our previous two slides, we see this very small Hammond's candlestick shape. Here instead, we see this T shape, followed by the gravestone doji, which is just the opposite, prices moving in an uptrend. Once you see this, we're expecting prices to move in a downtrend. Okay, so the reason for this kind of doji candlestick shape is because it forms when the open and the close price are equal or very close to equal. So that's why we don't see this body candle of the candlestick shape forming. So it's typically considered a neutral formation, suggesting that there's kind of an indecision between buyers and sellers. Of course, here we're seeing a bearish bias. Here we're seeing more of a bullish bias, but depends on the price swing and the general trend as well. So all of these three candlestick patterns that we've gone through so far give us a reversal candlestick pattern. Okay, now let's move on. I'm gonna look at the um oop, yeah, the next double candlestick patterns. So for these two, they're going to be two candlesticks instead of one. So here we have the bullish engulfing and bearish engulfing candle. Okay, so bullish engulfing basically is a sign that prices, you can see it's red first, means that prices are moving upwards. The open is here, close here. So our bullish candlestick that follows that basically closes above the previous candle's open. So previous candle's open is here, bullish candle's open would be higher. And the length of the candlestick should be engulfing or rather longer than the previous candlestick. That's why we call it engulfing. Okay, so it engulfs the previous red candle. Bullish candle then opens at or lower than the previous candlestick's close. Okay, oop. If we look at the bearish engulfing, you can see that the shape is kind of similar. Prices, again, your open is here, or rather, I guess here would be your close and open here. but it's kind of the same concept. So your open would just be here, or rather here. Okay, so it opens either at or above the previous candle's open, and it will close lower than the previous candle. Okay, so the main feature of this candlestick pattern is that the second candlestick's body just has to be longer than the first, and that's why we call it engulfing. Okay, both of these signals are more likely to signal reversals when they are preceded by four or more candlesticks. And we'll show you some examples in a bit as well. Okay, let's move on. So the next is our tweezers. So for tweezers, you can see it's a repeated shape. Basically, there are no upper wicks for both of the candlesticks. For tweezer bottoms, prices are moving downwards, and this signal is a sign that prices are going to reverse into an uptrend. Then the opposite would just be tweezer tops, in which prices are moving in an uptrend, and when you see this kind of candlestick pattern, it's a sign prices are going to reverse into a downtrend. Okay, I think these are pretty straightforward, and these candlestick patterns can often be found with an established support or resistance from your previous price movements. Okay, let's move on. Now we're gonna look at the top three triple candlestick patterns. Okay, starting off, we have our um morning star, morning star and evening star shape. Okay, so starting off with morning star, you can see prices are moving in a downtrend. It starts off with a large bearish candle, followed by a smaller bullish or bearish candle. So this doesn't have to be bullish, it can be bearish as well. And then last point would be a large bullish candle. Okay, and then we are expecting a subsequent bullish price action. Okay, of course, the opposite would happen for our evening star. Prices are moving in an uptrend first. It's made out of a long bullish candlestick, a smaller bullish or bearish candlestick, and subsequently a long bearish candlestick. And then we see a bearish price movement subsequently. Okay, so one of the limitations of this candlestick pattern is probably it's quite risky because it's not really backed up by volume or some other indicators. So for example, previously I was talking about how the tweezer candlestick patterns are quite often accompanied by support and resistance levels that's from previous price movements. So for this candlestick pattern, if you're just looking at it on its own, it might not be a very reliable signal. So normally with these candlestick patterns, we would use some other indicator as well. So if you're able to find support and resistance levels, that's great. But if not, we would use RSI as well to determine if prices are currently oversold, for example. So if it's oversold and we're looking at a morning star, then you know you have confluence and confirmation prices are gonna reverse and move in an uptrend. Okay, and of course that would be the opposite for evening star. Okay, next, let's look at our next candlestick pattern. We have the three black crows and the three white soldiers. So for these candlestick patterns, you can see it's pretty straightforward. It's just basically a continuation of whatever the trend is. Okay, so if we look at the three white soldiers that we saw earlier, prices were already moving in an uptrend. And let me go back to the example at the start. Okay, so here we saw the morning star formation, which I'll get through, which we saw earlier, and then prices moving upwards. The three white soldiers, okay, you can see this formation happening here. So it's not really a sign of reversal, it's more of a sign of continuation, or if prices are breaking above a specific resistance level or support level, that's also a signal for breakout. Okay, so here's the three white soldiers, and we subsequently saw prices breaking out above the resistance level. Okay, so I think it's pretty straightforward. The candlestick patterns are just basically three consecutive bearish or long bearish or bullish candles, depending on the three black crows or three white soldiers. Okay. Lastly, our top three triple candlestick patterns are the three inside up and the three inside down. For this, we're basically looking at um a double candlestick here. The main point would be that the bottom of the candlestick should line up with the previous candlestick. And the second candlestick should also be shorter than the first. Okay, and that's the same for inside down as well. Okay, these are also reversal candlestick patterns. So you can see prices are moving in a downtrend. Once you see this candlestick formation, we are expecting prices to reverse into an uptrend. And similarly for three inside down, uptrend into a downtrend. Okay, so this basically shows that this current trend, so if it's a bearish trend, it's basically a sign that your trend has lost momentum, and so a move in the other direction might be showing. So that's for three inside down. If it's a bullish momentum, it's kind of losing that uptrend and then moving into a downtrend. Okay, so these work better in a trend, so a specific trend, and it's not so good in markets that are moving sideways. Okay, let's move on to the top three reversal patterns. So firstly, we have the head and shoulders top. You can see the pattern basically starts off with a left shoulder, a head, and a right shoulder. So the swing high is over here. And this trend basically signals a bullish to bearish trend reversal. So prices are break out of this neckline and heading towards our target over here. Okay, so the neckline basically occurs when you connect the bottom of that reversal from the left shoulder and from the head. When you connect that, that's your neckline. Oops. Okay. Okay, so this pattern is actually considered one of the most reliable trend reversal patterns, and it's one of several top patterns that signal with varying degrees of accuracy that an upward trend is nearing its end. So we see prices making higher highs and higher lows, as you can see from this trend line here. Once it breaks out of that trend line, then you have kind of downward confirmation that prices are going to continue to drop. So you would put your target over here. Okay, next, let's look at the head and shoulders bottom. You know, this is just the opposite of the head and shoulders top, or it's also called, I believe, inverse head and shoulders. So, but it's basically the same thing. So it's basically identified when the price action of your security or your asset um price falls to the trough firstly and then falls below it. So it makes a lower low and lower highs, and then it rises again. And then it falls again, but not as far as the second trough. Once the final trough is made, which was basically the head, then price would hit upwards towards that resistance. Resistance here means this neckline level. So again, the neckline is when your swing high connects with your second swing high of the left shoulder and the right shoulder. So once that's made, once price has broken out that neckline, then you're going for a buy towards our target. Okay, so this pattern is quite recognizable as well to an experienced trader. So it's quite easy to use if you're able to recognize it. And also if there are very big market movements, you can time frame for the head towards your shoulder pattern is fairly long. So you can profit quite a bit if market moves significantly from your entry, which could be here, towards your target. Okay, so where would you place your stop in this case? Your target be here, you would place your stop somewhere below the neckline. So it still gives it some room to move around without you getting stopped out immediately if price does start to reverse. So it gives it some room to move or reverse back, and then it can still shoot up to your target. Okay, now we're looking at our double top. Again, double top formation patterns are quite easy to identify. You can see basically two triangle shapes. And these normally are they are bearish trend reversal pattern. So prices are moving in an uptrend, and once you see these formations, you're going for a sell towards a target that's somewhere below. The target, so the distance between where you enter versus your target profit should be about that same length or the same height as your triangle shape. Again, so that it gives it some room to breathe, some room to reverse and move around, but still make it to your target. Okay, so this is a very bearish technical reversal pattern because it basically shows that asset has reached this high price um, two times consecutively, but it has failed to move past that price. So it then shows a moderate decline. So yeah. So if you use this double top pattern with um a momentum pattern, so it could be maybe a MACD, it would be quite a bit more effective instead of just using a resistance level over here. Okay, so a double bottom, of course, would just be the opposite with prices moving in a downtrend and it tests this support level. It's unable to drop any further, so then it reverses twice consecutively and then moves upwards moderately towards this target. Again, your target level should be the height of your candlestick patterns. Okay, so one way to identify it and avoid any false signals is to look for that upswing, or in this case would be a downswing. So the price movement should be clearly indicated in a downtrend prior to the creation of this pattern. So this basically indicates that price has been making continuously lower lows and lower highs, which we see here. You can see this low is followed by a lower low. The high is followed by a lower high, or here as well. Okay, and then you want to make sure that you're able to find that initial trough. If we're looking at the double top, then your initial peak, um, because this would be the maximum level. So if price manages to break above it, that's not really a sign of a double top. So we find the trough again, and then your second peak price should more or less stop around that same level. Okay, it might even fall short of that first peak's height because price will kind of begin to collapse once more. Okay, and then once you draw this neckline, this dotted line, then you can go in for your sell or for your buy towards your target, which would again be that distance. Okay, okay, now let's look at our last pattern, which is your triple top. So this image is from Investopedia, but basically when you have a triple top, it's basically telling you that an asset is no longer rallying and that lower prices are on the way. So again, it's a bearish signal. So, okay, I guess the most significant shape here would be obviously the triple top. And then once price pulls back below that swing low, the two swing lows and the two troughs, then price breaks below the pullback lows, and then your pattern is complete. So if you're a trader, you would exit longs or enter shorts when the triple top completes over here, once it breaks below this pullback low. Okay, so if you are going in for a sell, in this case, if you're looking at triple top, you'll be going for a sell. So from here, you're going for a sell, you can place your stop loss above that resistance level. So above this triple swing high over here. Okay, so those three consecutive peaks are very similar to that head and shoulders pattern that we looked earlier. But in this case, your middle peak should be nearly equal to the other heights, the other peaks, rather than being higher. So it's also similar to the previous double top pattern that we looked at when the price reaches your resistance area twice, creating a pair of high points before falling. Okay, so it's traded essentially in the same way as your head and shoulders pattern that we went through earlier. Okay, looking at our triple bottom, again, we have that same shape. You have three swing lows instead of swing highs in this case. But it's basically the same. Prices break out of this neckline, which again is the connecting line between your swing. Here would be swing highs. Between the swing highs, once price breaks out of that, then you can go in for a buy towards your take profit. In this case, your stop loss would be below your triple bottom. Okay, I think my camera froze there for a bit. Can you guys see me now? Okay. Okay, now let's look at the top three breakout chart patterns. Okay, firstly, we have the falling wedge. So we are going in for a target, in this case, that's at least the size of a chart pattern for wedges and rectangles. Okay, so we have the shape that we're looking for here, and here's an example of what the falling wedge pattern looks like on your charts. So basically starts off with a rising trend, followed by a downtrend or your correction, and then it breaks out of that. So we're expecting prices to break out of it here and head towards our take profit. Okay, so falling wedges are bullish signals. Okay, one of the most I guess the easiest way to identify these is by looking at your trend lines. So here we have 1, 2, 3 swing highs. Once you connect those levels, you form this descending trend line. And if you connect these two levels, you also be drawing your trend line, and you can kind of figure out this shape as kind of a converging, the trend lines are kind of converging on your price chart. So that's an easy way to identify your wedge. Okay, so quite obviously the lines show the highs and the lows are either rising or falling at different rates, so it gives the appearance of a wedge since both lines are kind of approaching a convergence. Okay, um, okay, let's look at our bullish rectangle. Can you guys still see my screen? My screen suddenly blacked out for a second. I'm not too sure what happened. Can you guys see me? Okay. Okay, good. Because on my side my screen suddenly blacked out, so I'm not too sure what was happening there. But okay, getting back, we're looking at our bullish rectangle pattern. So basically what we are expecting here is prices are moving in an uptrend first. They're kind of moving sideways within this rectangular shape, and then we're expecting it to break out. So once it breaks out of this I guess trend line, once it breaks out of that, we have upside confirmation. The prices are going to continue upwards, and then we're going into for our take profit. Okay, so it's pretty straightforward. Basically consists of two parallel trend lines. So once you connect, again, for all these patterns, you're basically connecting the swing highs and the swing lows to form your pattern. So that makes it easier to spot any shapes as well. So your lower trend line acts as a support level, this one here, and your upper trend line here acts as a resistance level. Then these trend lines create kind of a rectangle shaped pattern. So this is what we call a consolidation phase. So during this pattern's formation, price moves sideways between the two trend lines. Okay, so yeah, this is called our consolidation period where neither your buyers or your sellers are in control and there's no real, I guess, trend. Okay, once the breakout happens, it actually breaks out above this entry and we're going for a buy towards our take profit there. Okay, next we have our bullish pennant pattern. So for a pennant pattern, we are looking for this kind of a shape here. Okay, so this occurs again after an uptrend. So you can see prices moving an uptrend here. And it indicates a potential continuation for upward movement. Okay, so I think this bullish pennant name is also a flag shape, if I'm not wrong. Because this is commonly this line here this shape is commonly referred to as a flagpole because it kind of resembles a flag shape. So once prices are moving in this bullish shape and it breaks out of this flag shape, then there is strong upward movement of the price of your security. Okay, again, the consolidation phase would be over here where there's no real trend. And the breakout from this consolidation period basically forms this triangle shape or like pennant shape, and then it'll happen upwards, so break above this trend line and hit towards our take profit. So you want to make sure that you don't place your stop loss too close to the bottom of your shape. Typically you place it below the first swing low, so it gives it room to breathe, so you don't get stopped out here. Okay. Okay, are there any questions so far? Okay, if not, let's move on to combine these patterns with what we've learned so that we get a better, higher probability breakout strategy. So if you guys have joined us for a while, you would know the support and resistance patterns that we use, the trend lines, oscillator indicators, and momentum indicators. Okay, but if not, I'll just briefly go through them right now. So earlier I mentioned support and resistance. Obviously, it's just the price at which an asset tends to stop falling, which will be your support, or stop rising, which is your resistance. Okay, and you use technical analysis tools like your trend lines, moving averages, chart patterns, so on and so forth. And we normally take note of these levels at your swing highs and swing lows. Okay, yep, so some things to take note of. Insignificant swings, you want to avoid using these levels as your support and resistance levels as well. Yep, here's another example. This is something that you should look out for. Significant moves up or down, obvious peaks and troughs, and clear market movement. Okay, another example here. So support and resistance levels obviously can be used as take profit and stop loss levels. However, using a recent swing high or low is a weak level if it's the only level. So that's why we mentioned using multiple swings, where at least two swing high or lows line up nicely, and it's a much better level to use. Okay, so some starting points. When picking your points, you want to make sure that there is a swing high or low, pullback or overlap level to start from. Go as far back as possible, and you want to make sure that you are just intersecting the wicks and not the bodies of the candlesticks. So for example here, you want to make sure there's a very clean cut of your candlesticks and you're not really doing this here where it's too messy. Okay, some more examples. Okay, now let's talk about the pullback and the overlap, support and resistance. Okay, because we've been mentioning pullback and overlap quite a bit in the previous slides. So if you're unfamiliar with what a pullback support is, it's basically a when it breaks out. So you can see here, for example, in this GIF, price is at a swing low, okay, and price has broken below that level. So it's a pullback level because we are expecting price to revisit it over here. And once price has revisited it, it then becomes an overlap level where your swing high and your swing low line up. So the pullback is kind of the in-between level before it becomes an overlap. Okay, so here's an example. We have three swing lows, making it a support level. Once price breaks below it, it then becomes a pullback level, and we're expecting price to revisit it and reverse off of it again. If we're talking about the support, prices are moving, prices react off of this resistance level at first. And once price breaks out of it, then comes a pullback support, and we're expecting price to bounce off of that level. Okay, combining both, here's an example. Using a big swing high resistance, the moment price surpasses it, it becomes a pullback support, and price has made a pullback to our pullback support level and bounced off of it perfectly. And the moment price bounces off of it, it then becomes a overlap support. Okay. Yep, here's another example. So you can see price normally does come back to revisit it after, since we have price bouncing off of it again. Here as well. So we can combine these with trend lines as well. If you're able to spot any of the candlestick pattern formations that we mentioned earlier, especially if you link them up with any of the pullback and overlap levels that we've mentioned, that will really strengthen your analysis. Combining them with trend lines, of course, this only works in a trending chart. If not, you can also look at any patterns that we went through. Okay, and combining it with channels as well, resistance and Ichimoku, like we did earlier as well. Okay. Yeah, I think that's all I have for you guys for today. Are there any questions? Okay, if there are no questions, um, that's it for today. Thank you guys so much for joining me. I hope you guys found this session helpful, and I'll see you guys again next week. Thanks, everyone. Bye. Thanks, everybody. See you guys next week.